Have you ever searched for a popular ETF like PTI, SCHD, or QQQ only to see your broker say, not available in your region? If you're investing from Europe, this isn't a mistake. It's by design. And today I'm going to explain why this happens, what it has to do with something called UCITS, and how some investors like myself are legally getting around it. And yes, there is a way you can still access US ETFs like SCHD and JEPI. Begin to understand the risks and the fine print. Let's get into it. Let's start with the basics. UCITS stands for Undertakings for Collective Investment in Transferable Securities. Yeah, it's a bit of a mouthful, but in simple terms, it's an EU regulation that sets the rules for how mutual funds and ETFs must be structured and marketed across European countries. The whole point of UCITS is to protect retail investors like yourself and myself. It ensures that funds are diversified, liquid, transparent, and come with easy to understand documentation, like the famous Key Information Document or KID kit. UCITS compliant ETFs have to disclose things like risk levels, cost and performance scenarios in a standardized format. That's great for safety and clarity, especially if you're new to investing. But here's where things get a little bit tricky. Most US-based ETFs, even popular ones like VTI or QQQ, do not comply with UCITS rules. Why is that? Because they don't publish a KID document. Providers like Vanguard or BlackRock already meet US regulations by the SEC. But they don't go the extra mile to meet EU documentation standards. And they're not required to. So what happens? Your broker, whether it's DIVO, Scalable Capital, or Trade Republic, is legally blocked from letting you buy those funds. Not because they don't want to, but because it's literally not allowed under PRIIPs regulation, which is part of the whole UCITS umbrella. And that means if you're a regular retail investor in the EU, you can't legally buy most US domiciled ETFs through a European broker. Because US ETFs, let's be honest, often offer better value than their UCITS counterparts. Let me explain. First of all, lower fees. Take, for example, VTI. It's a total US market ETF from Vanguard. The expense ratio is just 0.03. That's insanely low, especially when compared to a UCITS alternative like VU, SA, or VWC. And you're often paying like, 0.2 or 0.3% in those funds. Second, higher liquidity. US ETFs are trading massive volumes every day, so spreads are tighter, execution is smoother, and there is more price stability and volatile moments. And third, more variety. US investors have access to ETFs that just don't exist in UCITS form. Want income ETFs like SCHD, DIVO, JEPI, or QYLD? Want, for example, covered call strategies? Options overlay ETFs, innovation ETFs, you will find them all in the US but not in Europe. And fourth, and last but not least, tax strategy. Some US ETFs are structured with tax advantages for US investors, and while that doesn't directly benefit EU investors, there are use cases where non-EU platforms still make them attractive. But here's the important part, you're not completely locked out. So how do some investors still manage to buy these US ETFs? They use US-based brokerage platforms that accept non-US residents. Two of the most popular are, in my opinion, Firstrade and Schwab International. Let's break them down. Firstrade is great for beginners. There is no minimum deposit. Now there's no minimum deposit for Schwab either. There's no trading fees. It's very easy to sign up if your country is supported. And you get full access to US ETFs, stocks, and mutual funds. But it's pretty bare bones. Don't expect deep reporting or tax integration. You will need to handle your own tax documents in most EU countries, although that happens for Schwab as well. And Schwab International is a bit more premium. It has better customer support, it has more polished tools, and it's great if you're investing a larger amount. If you're a little bit more serious about building a long-term ETF portfolio with US exposure, Schwab offers, in my opinion, the better long-term experience. But if you're just testing the waters or want access without a large or huge deposit, Firstrade is more accessible. Now, before you run off to sign up, let me be clear. These platforms are not EU regulated. That means no investor compensation scheme like you get in the EU. You're responsible for currency conversion fees, Euro to USD. Dividend income may be taxed as source by the US, usually 15% if there is a treaty, and you will need to manually report gains and losses on your country tax regulation. This workaround is legit, by the way, but it's not beginner friendly. You will need to be confident managing your own tax and compliance setup. So where are the US ETFs people go out their way to access? Here are the few favorites, at least for me. SCHD is a high-quality dividend ETF with long-term growth. DIVO, dividend ETF and cover call strategy in one. JEPI is high income with lower volatility via options overlay. HELO for those seeking lower volatility. VTI is a classic total US stock market exposure. ETF, QQQ, as you all know, is a heavy tech exposure, great for long-term growth. And in my next video, I'm going to break down each of these in detail, or at least some of them that I find more interesting, including what they hold, how they perform, and whether they're worth the tax complications as well. So make sure you subscribe if you want to catch that. Thank you very much and see you in the next video.